everyone. Welcome to today's Finance 360-degree session in which we are going to discuss a very important notification of the Reserve Bank of India. So RBI has released different notifications for the commercial banks, for the small finance bank, for the regional rural banks, local area banks and the payment bank. So all these notifications are regarding the declaration of dividend. Okay. So today we will discuss that how the different banks are allowed to declare their dividends, what are the limits that have been imposed by the Reserve Bank of India, what are the criteria, what is the criteria that is given for the different banks. So all of this we are going to discuss in this video, where I will provide you the important points as well as I will provide you the idea that how you can remember the table, how you can remember the important points. Okay, there is logic behind the table, there is logic behind all the points. So once you understand the logic, you will be easily able to understand and remember from the examination point of view. So this notification is very important from the examination perspective that we are going to discuss in today's session. Okay, so in March 2026, the RBI has released a notification regarding the declaration of dividend and the remittance of profits for the commercial banks, as well as declaration of dividend by the small finance banks, regional rural banks, local area banks and the payment bank. All of this we are going to discuss in today's session in the easy terms. So give me a thumbs up if I'm clearly audible and the screen is visible, and the different percentages have been mentioned in the notification that we will be discussing, and this is very important from the phase 1 as well as from the phase 2 perspective of the RBI Grade B 2026 examination. So let's get started. But before that, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, as well as to join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel is given in the description box below. Okay. So now RBI commercial banks. First we will discuss the directions from the commercial banks perspective, then we will move forward with the other banks and the direction that has been given for the other banks. Okay, so RBI has released multiple notifications. Okay, RBI has released different notifications for the commercial banks, for the small finance banks, for the regional rural banks, for the local area banks and for the payment bank in regards to the declaration of dividend. So first we are going to discuss the perspective from the commercial banks side, and once we understand the regulations from the perspective of the commercial banks, it will be very easy for you to understand for the other banks also. Okay, so let's get started. The RBI has released the RBI commercial banks prudential norms on declaration of dividend and remittance of profits directions 2026. So first of all, RBI had previously also issued rules for banks about how they can declare the dividends to shareholders. First of all, I hope you know that the profit, a company, let's say a company is making the profit, how the profit is going to be distributed, in what areas the profit is going to be distributed. So there are three main areas where the profit is distributed. Okay, first of all, from the profit, the corporate profit tax has to be paid, or the tax has to be paid. Okay, after paying the tax, let's say the profit is 100 and 30 rupees has been paid as the corporate profit tax or as the tax, then whatever is left, 70 rupees is left now. From this, the company will keep some retained earnings. The company will keep some retained earnings, that is also known as undistributed profits. Undistributed profit, why the company is keeping with itself the retained earnings or the undistributed profit? For the further expansion of the company, or for handling the distress situation in the future, or for maintenance of the funding, or for maintenance of its expenses. Okay, so basically the company keeps some of the profit as retained earnings, as the undistributed profit, so that the company can handle the distress situation, so that the company can handle the expenses in the future operations, as well as if the company wants to do the expansion in the future, the company also keeps some retained earnings for that. So let's say the company is keeping 40 rupees as the retained earnings with itself. The rest of the money, that is now 30 rupees is left. Now this is given in the form of dividend to the shareholders. Okay, so this is the idea. So the dividend is given to the shareholders. Shareholders are the ones that own the shares, so they must be given some part of the profit, so that is dividend. So I hope you know that broadly the profit in the economic sense is divided into three parts. The corporate profit tax, first tax has to be paid, then the company keeps some retained earnings, the company keeps some undistributed profits. After that, whatever is left is given in the form of dividend to the shareholders. Now remember that the RBI is at the apex, top of the monetary system. if the banks give too much of the dividend to its shareholders, then the bank will not have enough of the retained earnings. The bank will not have enough of the money left with itself to maintain its expenses or to handle the distress situation. So RBI is saying that there are certain rules that the banks have to follow, so that they are not giving too much of the dividend, so that the banks are keeping some retained earnings to handle the distress in the future or to maintain its operations in the future. I hope this is very much clear that in a year, if a bank is earning the profit, the bank should not give too much of the dividend, that the bank do not have enough of the retained earnings to maintain its expenses in the future or to handle the distress situation. The bank should be keeping enough of the retained earnings. The bank should be keeping enough of the money in the form of capital with itself to handle the situation in the future. So this is the broad idea. So RBI previously had issued the rules for banks about how they can declare the dividends to shareholders, how much dividends they can issue to the shareholders. And foreign banks having branches in India, they can send the profits to their head office in the foreign country, but they also have to follow certain rules. Okay, so basically the banks in India, how much dividend they can provide to the shareholders, there are certain rules regarding that given by the RBI, as well as the foreign banks that have the branches in India, they can remit, they can send the profits to their head office abroad, but they also have to follow certain rules. Now RBI has now repealed the 2025 rules governing the dividend declaration by the commercial banks and replace them with the new rules. So now the 2025 earlier rules have been repealed, they have been cancelled out basically, and the new rules have been brought forward by the Reserve Bank of India. Now these new rules are effective from financial year 2026-27, that is from the 1st April 2026. These new rules are going to be applied for the new financial year. Okay, so the RBI has now repealed the earlier rules governing the dividend declaration and the remittance of the profits. Now the new rules have been brought by the Reserve Bank of India. These are the RBI Commercial Bank's Prudential Norms on Declaration of Dividend and Remittance of Profits Directions 2026. These are the new rules that are effective from financial year 2026-27. Now these directions shall be applicable to all the banking companies, corresponding new banks, State Bank of India and foreign banks that have branches in India, excluding small finance banks, local area banks, payment bank and regional rural banks. As I have told you that for these categories of banks, there are separate notifications that RBI has brought. Okay, so right now the directions that we are studying are from the perspective of the commercial banks and the foreign banks having branches in India. Okay, now coming to before starting with the directions, before starting with the data point, first you have to understand certain terminologies. Once you understand the terminologies, everything will become easier. Okay, so first of all, what is profit after tax? So profit after tax, the PAT is the profit after tax. Let's say this is the total revenue of a company. The total revenue of the company is 200 crores, let's say 200 crores. Okay, from the total revenue, deduct the total cost of producing the goods. Okay, cost of the goods. So you will get the total profit, that is also known as gross profit in finance or accounts terms. Okay, so total revenue, whatever is the total revenue, deduct the total cost, you have the total profit or the gross profit. Now from the gross profit, deduct the operational expenses of the company. Okay, so from the gross profit, deduct the selling cost like the marketing expenses, general and administrative expenses. So deduct the operating expenses of the company. Then from the gross profit, you are getting to the earning before taxes and interest. So you have got the earning before the, so total profit was total revenue minus total cost. Then from the total profit or from the gross profit, you have deducted the operational expenses. You have come to the earning before interest and tax. Now from the earning before interest and tax, deduct the interest expenses that has to be like the interest that has to be given on the debt that the company has taken. So now you have earnings before tax because you have deducted the interest. So now this is the earnings before paying the tax, or this is the profit before paying the tax. Now once you have paid the tax, from the earning before the tax, deduct the tax, okay, tax payment, and then you have the profit after tax or the earnings after tax. Earnings after tax is the net income or the net profit of the company that is left with the company. So from the revenue, deduct the cost. From the gross profit that you have got, deduct the operational expenses. From the earnings before taxes and interest, deduct the interest expenses. Then you have earnings before taxes. So deduct the taxes, all the payments. When the company has made all the payments, then you are left with profit after tax. So from the profit after tax, this is the profit from which the tax has been paid. This is the profit from which the tax has been paid. All the expenses have been paid. Okay. So now whatever is left should be going for the retained earnings, that is undistributed profit. From this profit after tax, the company will keep the retained earnings, undistributed profit, and the rest will be given in the form of dividend to the shareholders. That is the basic idea. Okay. That is the basic idea. So now there is something called adjusted profit after tax. What is the adjusted profit after tax? So the RBI has given the definition for the adjusted profit after tax. Adjusted profit after tax is nothing else. It is the profit after tax for a financial year in which the dividend has to be given, because from the profit after tax, after paying the tax, then whatever is left is kept in the form of retained earnings or the undistributed profits, and the rest is given in the form of dividend to the shareholders. So from the profit after tax, the dividend has to be paid to the shareholders. Okay. So from the profit after tax in a financial year, the dividend has to be paid. Now from the profit after tax, deduct the 50% of the net NPA. Net NPA is what? Net NPA is equal to gross NPA minus the provisions that the bank already has to cover the NPAs. Okay. So if the gross NPAs are, let's say 80, the provisions that the bank has is 50. Let's say out of the 80 crores of the gross NPAs, the bank already has the provisions. The bank already has the provisions of 60 crore. So net NPA is of 20 crores. Okay. So the adjusted profit after tax is profit after tax minus the 50% of the adjusted profit after tax is nothing else. It is the profit after tax minus the 50% of the net NPA. Okay, net NPA is the net non-performing asset, the net non-performing asset. If the net non-performing asset is 20 crores, so 50% of 20 crores is 10 crores. Okay, so whatever is the profit after tax minus the 50% of net NPA. So that is adjusted profit after tax. So now after discussing the terminologies, is there any confusion in the terminologies? So this is the idea. Now moving forward with the directions. So profit after tax is basically the profit from which the tax has already been paid. So after tax, whatever is the profit, from that the retained earnings will be kept by the company itself to handle the distress situation using the money, or to maintain its expenses in the future, while the rest will be given in the form of dividend to the shareholders. So from the profit after tax, the company keeps the retained earnings or the undistributed profits. Chalo. Now why declaring? Now board oversight and eligibility criteria for providing the dividend. As we have discussed that the company, that is the bank here, can provide the dividend. So there is board oversight while declaring the dividend or while sending the profit outside. So while declaring the dividend by the commercial bank in India, or while remitting the profit by the foreign bank that has branch in India. So if the foreign bank that has branch in India is remitting the profit from India to abroad, so the board of directors shall consider the current and projected capital position of the bank against the applicable regulatory requirement, against the applicable minimum regulatory requirement. So basically the board of directors has to consider that what is the current capital that the bank is having, what is the future capital that the bank is having. If the bank has enough of the capital with itself against the minimum capital requirement, then it is fine to declare the dividend, then it is good to remit the profit. But if the company do not have a good capital position in the current perspective or from the future perspective, if the board of directors think that okay, the bank does not have good capital position against the minimum requirements, then the board of directors have to decide that the dividend will not be shared Okay, so this is the idea. So basically, while declaring the dividend or while remitting the profits outside, the board of directors shall consider the current and the future capital position of the bank. The bank should have a good capital position, then only the dividend can be provided to the shareholders. Applicable capital buffers. The bank should also be maintaining applicable capital buffers. Okay, there is the capital conservation buffer. I hope you know that against the risk-weighted assets, the bank has to maintain the capital, because the loans, they have different kind of, the loans are the asset for the bank which is earning interest for the bank. So against the different loans, there is a different risk weight. Some loans have more risk, some loans has less risk. So against these risk weighted assets, against these loans or the assets of the bank that has risk weight, the bank has to maintain certain capital to handle the distress situation. If the distress come, to handle the distress situation, the bank has to maintain the capital with itself. So bank should have enough of the capital with itself in the current period. For the future also, good capital the bank should be holding, then only the bank can declare the profit. The bank should also have the capital buffers, additional capital buffers, other than maintaining the CRAR, that is the capital to risk weighted asset ratio. Other than maintaining the capital to risk weighted asset ratio of 9%, this is the minimum requirement. Okay, for the scheduled commercial banks, against the risk weighted asset, against the risk weighted loans, the bank has to maintain the capital of 9%. This is the capital to risk weighted asset ratio. Okay, the bank has to maintain minimum of 9% of capital against the risk weighted asset. Other than the CRAR, there is the capital conservation buffer of 2.5% that the bank has to maintain. So bank has to maintain the additional buffers for capital of 2.5%. So bank should also have applicable regulatory capital buffers, and the bank should also have adequate provisions, because as I have told you that the net NPA is what? It is gross NPA minus the provision. So bank should also have enough of the provisions to handle its NPAs, okay, to handle its NPAs. Taking into account the economic environment, the bank's long-term growth plans, so bank should be holding, because from the profit after tax, bank should be holding the retained profits or the undistributed profits for its future operations, for its future expansion also. After seeing how much money the bank requires, then only the dividend should be shared with the shareholders. Auditor's report of the financial statement, so the bank should have a good financial condition also. So this is the basic idea. Now, eligibility criteria, board overview, board oversight we have seen. Now coming to the eligibility criteria, a bank shall meet the following prudential requirements to be eligible to declare profits, to be eligible to declare dividends or remit profits. So if the bank want to declare the dividends and provide the dividends to the shareholders or remit the profit to its own country, basically they have to follow these conditions. Bank complied with regulatory capital requirement, as I have told you that the scheduled commercial banks, they have the minimum CRAR requirement of 9%. That means against the risk-weighted assets, against the risk-weighted loans, the bank has to maintain the capital of 9%. Okay, as well as there is the capital conservation buffer. Additional buffers that the bank has to maintain is 2.5%. So bank complied with regulatory capital requirement at the end of the previous financial year. In the previous financial year also, the bank was maintaining good capital buffers, as well as the bank had the CRAR, as well as continue being compliant in the current financial year in which the bank is declaring the dividend. So in the previous financial year also, in the current financial year also, the bank should have enough of the CRAR, the bank should be meeting the minimum requirements, and the bank should have enough of the buffers also. After paying the dividend, the bank must still meet the minimum capital requirement. So after the dividend has been paid from the profit after tax, the dividend, when the dividend has been paid to the shareholders, after that also the bank should have the CRAR, the minimum CRAR, and the capital conservation buffer. That means if the bank has paid the dividend, the bank cannot say that now we do not have the money in the capital buffers, now we do not have the money in the capital requirement. So bank cannot say so. Bank should have the minimum requirement met. Okay, the bank incorporated in India shall have positive adjusted PAT. So adjusted profit after tax, as I have told you, adjusted profit after tax is profit after tax minus the 50% of net NPA. So the bank that is incorporated in India, that is the Scheduled Commercial Bank of India, should have a positive adjusted profit after tax, then only it will be allowed to provide the dividend to its shareholders. Okay, that is the idea. Now, a foreign bank operating in India through the branch mode, so a foreign bank having a branch in India shall have a positive profit after tax. So in the requirement of the foreign bank having branch in India, they do not need to have the positive adjusted profit after tax. They just need to have the positive profit after tax. Then they can remit the profits to their head office. Okay, the bank is not subject. So the foreign bank having a branch in India or the Scheduled Commercial Bank of India, they should not have any restriction from RBI or other authorities on declaring dividend or remitting profit. So if the bank is following all these conditions, then the bank can declare the dividend or the bank can remit the profit. Okay, this is the idea. Any confusion? Chalo, moving forward of the quantum of dividend. Now we have understood the board oversight, the eligibility criteria. Moving forward with the quantum of dividend payable by banks incorporated in India. That means how much dividend can be paid by a bank incorporated in India, or how much dividend can be paid basically. Okay. So first of all, the dividend can be paid on the basis of common equity tier 1 ratio. Now first of all, I hope you know that the CRAR, now the CRAR is how much for the scheduled commercial banks? The CRAR for the scheduled commercial banks is 9%. This is the minimum requirement by the Reserve Bank of India, that the scheduled commercial bank should be holding the capital against the risk-weighted assets of 9%. So banks should have the capital of 9% against the risk-weighted assets. Okay, so this is the CRAR requirement. This is the capital requirement. Now the capital can be held by the bank in the tier 1 capital form or tier 2. Okay, so the capital can be tier 1 capital or tier 2 capital. So the capital to risk-weighted asset ratio that the banks have to hold can be in the form of tier 1 capital or tier 2 capital. Okay, tier 1 capital is the common equity tier 1 capital. See, tier 1 capital is the liquid capital that the banks can use during the time of distress. Okay, this is the go-to capital that the bank can use during the time of distress. Whenever there is distressful situation, the bank can use this kind of capital. Now tier 1 capital consists of common equity tier 1 capital and additional tier 1 capital. Common equity tier 1 capital, this is the most liquid capital that the bank has. This in the common equity tier 1 capital, like out of the profit after tax, the bank is keeping the retained earnings or the undistributed profit. So this retained earnings or the undistributed profit, they go under the common equity tier 1 capital. So this is the most liquid capital that the bank has, because the bank has the liquid money. Okay, so you can understand common equity tier 1 is the most liquid capital. Tier 2 capital is like a capital that the bank has, the assets that the bank has in the physical form, or the tier 2 capital is not so liquid. CRAR requirement is 9%. This is the minimum requirement for the scheduled commercial banks. Out of this, the tier 1 requirement is 7% and tier 2 is 2%. Okay, so basically CRAR of 9%, tier 1 should have 7% at least, tier 2 2%. Okay, common equity tier 1 capital 5.5%. Additional tier 1 capital is 1.5%. These are the requirements. Okay, so tier 1 capital should have minimum of 7%. Tier 1 capital should be minimum of 7% of risk-weighted assets. Out of this, 5.5% is common equity tier 1 capital. Now, other than this 9% of the CRAR, you can understand that the capital conservation buffer is 2.5%. Okay, this is all static. I'm giving you the understanding so that you can understand the table and you can remember the table. Capital conservation buffer is 2.5%. That is the additional buffers that the bank has to maintain. Now, these additional buffers that the bank has to maintain is in what form? In the form of tier 2 capital or tier 1 capital? In the form of common equity tier 1 capital or additional tier 1 capital? Anyone knows that the capital conservation buffer, if the bank is maintaining the capital conservation buffer, that should be in the form of common equity tier 1 capital. That means in the common equity tier 1 capital, the bank has to maintain additional 2.5% of capital. Okay, so in total 8% is the common equity tier 1 capital that the banks have to maintain. So basically CRAR requirement is 9%. under the capital against the risk weighted asset, tier 1 capital should be 7%, minimum 7%, and tier 2 capital is the left out 2%. Okay, in the tier 1 capital, there is the common equity tier 1 capital, that is the most liquid capital, that should be 5.5%, minimum of 5.5%. Rest 81 capital, additional tier 1 capital can be 1.5%. The bank also has to maintain additional capital conservation buffer, that should be in the form of common equity tier 1 capital. So the bank has to maintain additional capital conservation buffer of 2.5% in the form of common equity tier 1 capital. So in total, how much of the common equity tier 1 capital the scheduled commercial banks have to maintain, adding the capital conservation buffer of 8%. So if the bank has less than 8%, if the bank has less than 8% of common equity tier 1 capital, should the bank be allowed to provide the dividend? If the bank has less than 8%, if the bank has less than 8% of the common equity tier 1 capital, that means the bank do not have enough of the liquid capital as per the minimum requirement. Common equity tier 1 capital with the capital conservation buffer should be 8%. So common equity tier 1 capital should be 8% as per the minimum requirement. So if the bank does not have 8% of common equity tier 1 capital, that means the bank does not have enough of the liquid capital. That means the bank cannot give dividend. This is the basic idea. This is the basic idea. I hope this is clear now. If this is clear, that means the whole article is clear. It will be very easy for you to understand the other paragraphs now, the other ideas now. Okay, so if the bank has up to 8% of the common equity tier 1 capital, that means the bank should not be allowed to give the dividend because the bank does not have enough of the liquid capital. But if the bank has above 8% of the common equity tier 1 capital, that is the most liquid capital that the bank has, or up to 10%, then the bank should be allowed to give 20% of the dividend from its adjusted profit after tax, Okay, here you can see till the bucket 5 by 2%, by 2% the bracket is increasing. After bucket 5 by 1% the bracket is increasing, that's it. And 20% is the difference in the, like, initially 10% is the 10% is the increase in dividend. Got it? So now it is easy for you to understand the table. I hope it is easy for you to remember the table also, because if we are talking about the commercial banks, they have to maintain the common equity tier 1 capital of 8%. 5.5% generally, and including the capital conservation buffer of 2.5%. So 8% is the minimum requirement of the common equity tier 1 capital. If the banks have up to 8% only, that means they can only they cannot provide any dividend. But if they have more than 8%, up to 10%, they can provide 20% of the dividend, 10% to 12%, 30% of the dividend, and so on and so forth. Till the bracket 5, the percentage is increasing by 2%. After the bracket 5, the percentage is increasing only by 1%. What is this Z now? What is this Z now? Have you heard about domestic systemically important banks? Have you heard about domestic systemically important banks? I hope all of you have heard about domestic systemically important banks. They are too big to fail banks. And which banks are under the category of domestic systemically important banks? The State Bank of India, the HDFC Bank and ICICI Bank, they are the banks that are under the domestic systemically important banks. And these banks have to maintain additional common equity tier 1 capital. That means all the scheduled commercial banks have to maintain the CRAR of 9%, the common equity tier 1 of 5.5% with additional capital conservation buffer of 2.5%. But these domestic systemically important banks have to maintain even higher common equity tier 1 capital of 0.80% for the State Bank of India. HDFC Bank has to maintain 0.40% high additional common equity tier 1 capital. So basically this Z shows that domestic systemically important banks have to maintain the higher buffer. So basically for the State Bank of India, the Z will be 0.80. For the HDFC Bank, it will be 0.40, and so nothing much to discuss here. Any confusion, anyone? Any confusion here? So basically this Z is nothing else. This is the Z. This is applicable to the domestic systemically important banks because this Z is the additional common equity tier 1 capital that the domestic systemically important banks have to maintain. Z shall be 0 for the other banks that are not in the category of domestic systemically important banks. That is it. Okay. So what is the minimum, like 0% of the dividend will be allowed from the adjusted profit after tax for which category of banks? For which category of banks that have up to 8% of common equity tier 1 capital. Okay, so this is what you have to keep in mind. If the bank has above 20%, if the bank has above 20% of common equity tier 1 bank, this is the normal banks that we are talking about, not the domestic systemically important banks. So if the bank has above 20% of common equity tier 1 capital, the bank will be allowed 100% of the adjusted profit after tax, the dividend from the adjusted profit after tax. Okay, so bank will be allowed to provide 100% of the dividend from the adjusted profit after tax. This is the idea. Now, one more thing that you have to keep in mind is this spatial line that we have not discussed till now, that we are going to discuss now. So basically, let's say that the profit after tax, let's say the profit after tax is 100. Okay, let's say the profit after tax is 100 rupees. What is adjusted profit after tax? Adjusted profit after tax is profit after tax minus the 50% of net NPA. Net NPA, let's say, is 20. So 50% of net NPA is 10. So what is the adjusted profit after tax? What is the adjusted profit after tax? It is 90. Adjusted profit after tax is 90 crores. Let's say adjusted profit after tax is 90. From this, the dividend can be provided. Now let's say that the bank is in the bucket 4. The bank is in the bucket 4. That means 40% of the 40% of the adjusted profit after tax. But what if the bank is in the bucket 10? The bank is in the bucket 10 and the bank is allowed to give 100%. The bank is allowed to give 100% of the dividend from its adjusted profit after tax. That means the bank can give 90 crores as dividend. The bank can give 90 crore as dividend. So the bank is giving a lot in the dividend form. Here there is a clause that has been added that these are the buckets that the bank has to follow. But in aggregate, the bank should not increase its dividend more than 75% of profit after tax. That means profit after tax is 100 rupees. The bank can maximum give 75% of the profit after tax as dividend, that is 75 rupees. So will the bank be allowed to give 90 rupees as dividend? No. Even if the bank is falling in the bucket 10, the bank will not be allowed to give 90 rupees as the dividend because the maximum that the bank can give is 75% of profit after tax. I hope this is very much clear that the bank can fall in any of the bucket. The bank can provide, let's say the profit after tax is 100 crores, deduct the 50% of the net NPA to come to the adjusted profit after tax. Now net NPA is 80 crore. So 50% of 80 crore is 40 crore. 40 crore minus profit after tax. Profit after tax is 100 crore. Now what is the adjusted profit after tax? That is 60 crore. That is 60 crore. Now, if the bank is falling in bucket 10, if the bank is falling in bucket 10, that means 100% of dividend can be given against the adjusted profit after tax of 60 crore. So, bank can give 60 crore, 100% of adjusted profit after tax means 100%, that is 60 crores, the bank can give as dividend. Is it allowed? Yes or no? You have to tell me yes or no. Is it allowed to give 60 crore as dividend? Yes, it is allowed. Why? Because it is under the limit of 75% of profit after tax, that is 100 crore. So the bank can max give 75 crores. If the 100% of adjusted profit after tax is 60 crore, that is under the limit of 75 crore. That is not exceeding 75 crore. So this is the idea that a bank incorporated in India which satisfies the eligibility criteria above. If the bank is satisfying the eligibility criteria, the bank can declare and pay dividend up to the limits that has been determined. If the bank is in bucket 10, it can give 100% of dividend as a percentage of adjusted profit after tax. But in aggregate, the bank cannot provide more than 75% of profit after tax. So if the 100% of adjusted profit after tax is within the limit of 75% of profit after tax, that is fine. That is fine. But if the 100% or if a percentage of adjusted profit after tax is higher than the 75% of PAT, that is not allowed. Only up to 75% of profit after tax can be given in the form of dividend. Okay. Now, why is this clause made? Why only up to? Because profit after tax should be distributed. Profit after tax has been paid from the profit, so the profit after tax money should go in the form of retained earnings or undistributed profit that should be kept with the bank, and the rest should be given in the form of dividend to the shareholders. So 75%, it has been mandated that up to 75% of the profit after tax can go to the dividend, so that at least 25% is kept with the banks in the form of retained earnings. Okay, so this is the idea. So basically 100%, even 100% of the dividend can be given, but from the adjusted profit after tax that cannot exceed 75% of profit after tax. Okay, so this is the idea. Chalo. Moving forward, of quantum of dividend payable by banks not incorporated. Not incorporated in India, now we will discuss. So a foreign bank operating in India in branch mode that satisfies the eligibility criteria, that means it has a positive profit after tax, it is maintaining the capital adequacy ratio, it is maintaining the capital to risk weighted asset ratio and such, they can remit net profit or surplus earned arising out of their business in India from their branches in India. They can remit the profit outside without prior approval of the Reserve Bank of India, subject to the conditions that the accounts of the bank are audited, and in the event of more remittance, that means more money has been remitted by mistake to the head office that is in foreign, the head office of that foreign bank immediately shall return the excess remittance. So basically the foreign bank operating in India in the branch mode, if they satisfy the eligibility criteria, that means they are maintaining good capital adequacy ratio, they have good capital in the previous financial year, in the current financial year, they have good like positive profit after tax, they can send the money, they can send the net profit, that is the profit after tax, they can send the net profit to their head office, and they do not require the prior approval of the Reserve Bank of India. But if there is any excess remittance, that has to be returned to India. Okay. Profits not eligible for dividend or remittance. So there are certain profits that are not eligible for dividend or remittance, that is extraordinary profit earned by banks from one time or unusual event. So that cannot be given in the form of dividend or remittance. If the audit report by the statutory auditor, if by the legal auditor, the audit report states that there is overstatement of the profit after tax, that is there is the increase, there is the overestimation or there is the overstatement of profit after tax, the bank has reported higher profit than what the bank has actually earned. So the excess portion of the profit that has been declared by the bank cannot be provided in the form of dividend, because that excess profit is not present. The bank has just overstated its profit. So then the bank is not allowed to give the dividend from that overstated amount, because that overstated amount is not present as per the auditor. Bank shall not pay dividend or repatriate profits, send profits out of net unrealized gains arising on fair valuation of level 3 financial instruments. Level 3 financial instruments are the illiquid financial instruments which have unobservable valuation. That means the valuation is not easily observed in the market space. Okay, and they are very illiquid, they are not liquid, they are not easily sold and purchased. Okay, so bank, if they think that there are the gains that are happening from the level 3 financial instrument, but these gains they have unrealized, they have been unrealized, that means they are not still the bank has not still got them. So if there are the unrealized gains, from these unrealized gains the bank cannot provide any dividend or such. Okay, these are the unrealized gains that the bank can show in its book, but the bank cannot share the dividends on behalf of the unrealized gains on behalf of the valuation of level 3 financial instruments, because they are very illiquid, they are very much unobservable in terms of valuation. Next, a bank paying dividend or remitting profits to head office shall report to the Department of Supervision of the RBI within a fortnight of declaration of dividend or remitting profits to head office. Now coming, so we have completed the article from the commercial bank perspective. Now we will discuss the article from the perspective of small finance banks, payment bank, local area banks and regional rural banks. As I've told you that separate notifications have been released for these other categories of banks. Okay. So first of all, for the small finance banks and the payment banks, they have to maintain the CRAR of, anyone knows that how much of the CRAR, how much of the adequate capital the small finance banks and the payment banks have to maintain. It is not 9%. So what percentage is it? What percentage they have to maintain? Anyone? So see, the small finance banks and the payment banks, they have to maintain 15% of the CRAR. So the small finance banks and the payment banks, they have to maintain higher CRAR of 15%. So they do not require the capital conservation buffer. The RBI has not stated the capital conservation buffer for the small finance bank and the payment bank separately, because already the small finance bank and payment bank are maintaining very high CRAR of 15%. This is the minimum regulatory requirement. Okay. This is the minimum regulatory requirement. Out of the CRAR, tier 1, like the capital against the risk-weighted asset should be maintained in the form of tier 1 capital and the tier 2 capital. It is said that the tier 1 capital should be minimum of 7.5%. So that's why if the small finance bank or payment bank, if they have up to 7.5% of the tier 1 capital, then they are not allowed to provide any dividend. Okay, so this is the basic idea that I hope you have understood, that the CRAR, the tier 1 in the CRAR of the small finance bank and payment bank, tier 1 capital should be minimum of 7.5%. If the small finance bank and payment bank have up to 7.5% of the tier 1 capital only, that means they are not able to maintain the tier 1 capital, or they are only maintaining minimum of the tier 1 capital, so they cannot pay the dividends. But if they have more than 7.5% of the tier 1 capital, then they can provide the dividend. Okay, here you can see initially same in the form of like the starting 5 buckets increase by 2% in the category, and the rest increase by 1%. Okay, that you can see. The same idea will continue. Now for local area banks, the CRAR requirement is 9%. Directly for local area banks, the CRAR requirement is 9%. This is the minimum requirement. If the local area banks are only able to maintain the minimum requirement, then they cannot give the dividend to their shareholders. But if they are maintaining more than 9%, then they can give the dividend. And similarly, in this initial 5 buckets, the percentage increases by 2%, while in the rest of the buckets, the percentage is increasing by 1% only. That is the idea. Now tier 1, again for regional rural banks, for RRBs, like for the scheduled commercial bank, they have to maintain the CRAR of 9%, out of which tier 1 capital should be 7% and the tier 2 capital can be 2%. So the regional rural banks have to maintain minimum of 7% of the tier 1 capital. They have to maintain minimum of 7% of tier 1 capital. So if they are only maintaining minimum, they cannot give the dividend from their adjusted profit after tax. But if they are maintaining more than 7% of tier 1 capital, then they can give the dividend. That is the basic idea. Any confusion, anyone? Chalo. So this is the idea that I have made you understand, that first of all, the scheduled commercial banks or the commercial banks, they can provide the dividend from their adjusted profit after tax if they have the common equity tier 1 capital of more than 8%. Okay, if they have common equity tier 1 capital of less than 8% or equal to 8%, the dividend from the adjusted profit after tax will be 0%. Okay, but if they have more than 8% of the common equity tier 1 capital, they will be allowed to give the dividend, okay, of 20%, 30% and so on and so forth. Now for the small finance banks and for the payment banks, if they are maintaining the tier 1 capital, if they are maintaining the tier 1 capital of more than 7.5%, then they can give the dividend. If they are maintaining less than 7.5% or equal to 7.5%, they cannot give the dividend. Dividend from the adjusted profit after tax will be 0%. For the local area banks, it is on behalf of the CRAR. They have to maintain 9% of the CRAR. So if they are maintaining more than 9% of the CRAR, then they can give the dividend. For the RRBs, if they are maintaining the tier 1 capital of 7%, more than 7%, then they can give the dividend. Okay, more than 7%, then they can give the dividend. More than 9% of the CRR for local area banks, then they can give the dividend. More than 7.5% of tier 1 capital for small finance bank and payment bank, they can give the dividend. Okay, so this is the idea. And for the starting till 5 buckets, till bucket 5, there is the increase by 2% in the percentage form, and after that there is only 1% increase in the percentage form. That you can keep in mind. Okay, so the top parameter and the last, this keep in mind. Now, regardless of the bucket limit, like in the commercial bank's case, the adjusted profit after tax, the 100% of dividend can be given from the adjusted profit after tax, but from the profit after tax only 75%. This is the maximum limit. Okay, so even though 100% of dividend can be given from the adjusted profit after tax, but this is limited to 75% of the profit after tax for the commercial bank. For the scheduled commercial banks and for the payment banks, the same limit will be followed. That is 100% of dividend can be given from the adjusted profit after tax, but this is limited to 75% from the profit after tax. But for the local area banks and for the RRBs, this limit is 80%. This limit is 80%. That means 100% of the dividend can be given from the adjusted profit after tax, but only 80% can be given from the profit after tax. This is the limit. So even though you can give 100% of the dividend from the adjusted profit after tax, but this is limited to 80% of profit after tax. Okay, it should not increase, it should not exceed 80% of profit after tax. So this is it. This is it for today. I hope you understood everything very clearly. And as I have told you that for the regional rural banks, for the small finance banks, for the payment banks, for the local area banks, there are separate notification that the RBI has released. Now remember that when we talk about the commercial banks, when we talk about the commercial banks, here we are also talking about the foreign branches. That's why we are talking about the declaration of dividend by the commercial bank and the remittance of profit by the foreign bank branches in India. So they remit the profit. But when we talk about the RRBs, when we talk about the small finance banks, when we talk about the local area banks and the payment banks, in the notification of the RRBs, SFBs, LABs, there is only the mention of declaration of dividend. There is only the mention of declaration of dividend because the foreign branches are discussed in this commercial bank direction only. Okay. So when we talk about the RRBs, small finance bank and the payment bank and such, there is directly only the mention of declaration of dividend. And the other norms are more or less same, just the table was different that I have shown you. And how you can remember the table is tier 1 capital for small finance bank, the minimum requirement of tier 1 capital is 7.5%. CRAR for LABs, minimum requirement is 9%. That is same for the scheduled commercial bank also. Tier 1 requirement for the RRBs, that is 7%. Okay. Common equity tier 1 requirement of the scheduled commercial bank, that is 8%, because the scheduled commercial bank, they also have to maintain the capital conservation buffer, which the other category of banks are not as much required to maintain. Chalo. Now, a bank declaring dividend, a regional or rural bank. See, this is the slight difference, because the regional rural bank, they are supervised by the NABARD. They are regulated by RBI, but they are supervised by NABARD. That's why in the case of RRBs, a bank, a RRB declaring dividend shall furnish the report to the Department of Supervision of the NABARD. While the other category of banks, small finance bank, regional small finance bank, local area banks, payment banks, scheduled commercial bank, they have to provide the report to the Department of Supervision of RBI, but only the RRBs have to provide the report to the Department of Supervision of NABARD. Okay, as well as the RRBs, they do not. The RRBs, the other directions is same. The profit not eligible for dividend for RRBs. So yes, first and second point is same, but this third point, this is not valid for RRBs. This is not valid for RRBs because I think the RRBs, they do not invest in the level 3 financial instruments. So this third line is not applicable for RRBs. The rest of the direction is same for the different kind of banks. Okay, RRBs, they have to provide the report to the Department of Supervision of the NABARD. And when we talk about the profits not eligible, so the third point is not eligible for RRBs. That's it. Chalo. So this is the first question. I hope you will be easily able to answer this question. Okay, Avnish, do share your doubt. So this is the first question in which you have to tell that RBI has recently released prudential norms on declaration of dividend directions 2026. Which of the following statement is or are correct? Correct statement you have to tell, okay? And read the statements very, very carefully and then try to answer the question, okay? So RRBs, do they have, can they provide like 75% of the PAT? Their dividend should not exceed 75% of the PAT. Small finance bank, their dividend should not exceed 80% of the profit after tax. Adjusted profit after tax is profit after tax minus 50% of the net NPA. So do read the statements very, very carefully and then try to answer this question. The second question is direct a bank incorporated in India which satisfies. So as per the RBI commercial banks prudential norms on declaration of dividend by the commercial banks of India, by the scheduled commercial bank of India, and remittance of profit by the foreign bank branches in India, they remit the profit to outside. So basically, as per these directions, a bank incorporated in India which satisfies the eligibility criteria above may declare and may pay dividend up to the limits prescribed, but in aggregate not exceeding how much of the PAT. That means as per the table, the dividend can be given from the adjusted profit after tax, but it should not exceed what percentage of the profit after tax. So that you have to answer, okay? Chalo. Any confusion anyone has, any doubt, any query anyone has? Because then if there is no confusion, I will be closing the session. So this is it for today. Thank you everyone. Thank you for joining. I hope you enjoyed the session. Avnish, that is not notified by the RBI. Like, I will have to see it more carefully. Okay. Do comment down below. Okay. Do comment down below your query. I will also search upon it because I'm not able to remember the exact limit or if it has been defined in the pilot or not. So I will also have to see it. Okay. Chalo. Okay. Thank you everyone and thank you for joining the session. I hope you enjoyed the session. See you in the next session. If there is any question, any query you have that